Good afternoon, everyone. It's Monday, the 26th of August. Welcome to another edition of Monday Market Picks. My name is Silan Wickramasinghe. I'm the head of research for MIBG Securities here in Singapore. Jerome Powell, he's saying the time has come, at least for interest rate cuts. That was a highlight of Friday's meeting at Jackson Hole, where all the central banks met. And that's exactly what the markets wanted to hear. We're seeing green across the board in most of the markets in Asia. So I'm going to talk a little bit about what this means to our markets here in Singapore, what it means to the Singapore stocks and some of our top picks there. We also then have the head of regional research, Anand Padmakanthan, joining us. He's going to be talking about the broad implication to ASEAN. Particularly, we've got a new prime minister in Thailand. We've got a little bit of political unrest in Indonesia. What are the implications? What are the top picks? But first, let's start with our macroeconomist, Brian, who's joining us. Brian, welcome to the show. Now, Brian, Singapore's core inflation cooled to a 26-month low. Can you take us through this reading and what are the key highlights?
Hi, Dylan. Thanks for having me. Yeah, so core inflation cooled to 2.5% on an annual basis in July. This compares to the 2.9% rate seen in June, and it was the lowest print since February of 2022. So breaking it down, services were the main driver of inflation easing. Services inflation moderated to 2.9% as compared to 3.4% in June. And this was primarily on holiday expenses, which rose at a slower year-on-year rate of 2.7% as compared to 5.6% in June. So you had, for instance, package tours, hotels, and other expenses all cooling down. Basically, what's happening is that travel costs are moderating on the back of a strengthening Sing dollar and also the ramp up in airline capacity globally. However, some other components remain sticky, partly because our labor supply remains tight. So education inflation edged down to 3.1% from 3.3% in June. Healthcare inflation rose to 3.9% from 3.8% in June. So you can see these are still above the historical norms. And food inflation remains relatively elevated at 2.7%, given that the price of food services like restaurants and all that are 3.6% higher year on year.
Got it. Well, I think the message for me is time to go on holiday. But what does this do to your forecast, Brian?
Yeah, so we are maintaining our forecast for core inflation at 2.8% in 2024. Basically, looking at the outlook, we do not actually expect core inflation to continue moderating at the same pace that we saw in July. We think the last leg of this inflation may be tougher, given that the labor market still remains relatively tight and businesses are still passing on their earlier increases in cost of labor, administrative prices, and so on and so forth to consumers. Do note that qualifying salaries for S-Pass renewals will take effect, higher qualifying salaries will take effect from September, and this will actually raise labor costs for businesses. However, as the impact of the 2024 GST hike drops out, we are forecasting core inflation sliding to 1.8% on average in 2025, and that represents a slight step down from our previous forecast of 2%.
Got it. So do you think the MAS will finally start to ease its Sing dollar appreciation policy now?
So we expect MAS to still maintain their policy stance this year, given that core inflation remains sticky. But nonetheless, progress on this inflation will open the door for MAS to ease the near slope in January 2025, when both core and headline inflation will be comfortably below 2%.
Got it. Thanks, Brian. That was Brian, a macroeconomist for Singapore, joining us. Now, some of you have written to me asking, what are some of the key areas that we will discuss during the show. So the easiest way to find that out is to actually download our research, our weekly newsletter, which comes out every Monday morning before the market opens. You can actually do that by scanning the QR code that's on your screen now, or actually sign up for the mailing list. And also you can download this from our app as well. Now, let's take a look at interest rate cuts, and what the implications are for the Singapore market. That's our top idea for this week. The Powell pivot seems to be finally underway, going by the commentary that we heard in Jackson Hole on Friday. With the US now on a comfortable path to hit the 2% inflation target. We think rate cuts will start to happen as early as September. Now, what we've done is in Singapore, we actually ran a screen on all the stocks that are on SGX that are over $500 million in market cap to identify who can actually be some of the beneficiaries of this. Obviously, companies with high levels of indebtedness will actually have the most positive impact as the funding costs start to come down. So we use three metrics here. Which companies saw the biggest jump in interest costs going up to the second quarter of 2024? How sensitive are these companies in terms of operating metrics to debt? So basically, how much of their EBITDA is being eaten up by interest costs? And also, which companies have their largest share of earnings being taken away from interest costs as well? Now, on the metrics of biggest interest cost jump, we saw SATS, Parkway Life, and iFast being some of the biggest interest cost jumps up to the second quarter. So obviously, as interest rates to come down, these companies should see some of that burden being eased. In terms of operating sensitivity, we see Wing Tai, Pacific Century, as well as Hong Kong Group being the most impacted. And in terms of interest to earnings impact, the most impacted are Golden Agri, Fraser's Property, and Ola. So I think those are some of the names that you should be looking at. And these are not names that we cover on the research side, but these are potential names that can benefit from interest rates going down. Of course, the real world impact for any of these companies may not be as immediate as when the first rate cuts happen, because there will be some of their debt which is fixed and some of their debt which is variable, and there's also duration risk as well. So it might take some time to actually finally start to show through in terms of results. Now, on top of the screening that we've done, we did a bit more further work where we looked at structurally what are the most interest rate sensitive sectors. And these are the REITs, industrials, telcos, as well as the banks. And here we see that the REITs have the most significant potential upside impacts from three areas. The first is lower interest rates could lead to lower cost of capital for a lot of these REITs. So that means that the way we value these REITs on dividend discount models means that their target prices will go up. This will also having low interest rates will lubricate capital recycling, more transactions. So that will also give additional catalysts to these REITs. And finally, I think as rates come down in things like fixed deposits and treasury bonds, investors will be looking to move towards more higher yielding assets like the REITs. And Singapore's REITs have historically been a good refuge during times of low interest rates. Some of the names that Krishna thinks that will benefit from this is CICT, CDL Hospitality Trust, Sendas REIT, FCT, FEHT, as well as Suntec REIT. Now, moving on to telcos, we find that historically the sector performance has had a negative correlation to where interest rates are going. In fact, if you look at 2022 to the first half of this year, the negative correlation is close to 90% versus US bond yields. And even if you go longer than that, it's still around 60-70%. So pretty high correlation. So lower interest rates should make this sector perform. One of the key picks that we have here is Netlink Trust. The industrials should also enjoy lower cost of capital, and that should actually drive their valuations higher, because a lot of analysts use discounted cash flow models to value these companies. So that will drive valuations higher. Plus, we think that margins and more transaction will happen during a period where interest rates are low. Now, a lot of this is positive. On the other end, for the banks, things will be a little bit more negative. We think the net interest margins for the banks will get hit. Although when we look at what a lot of these banks said during the second quarter, it might be at a slower pace because they have managed to hedge some of their exposure and build some duration. But loan growth, when we looked at cycles like this in the past as well, it takes a while to start ramping up. Just because you have a 25 basis point cut, say in September, you're not going to suddenly see everyone rushing to take loans. So that's going to take some time, and that means that as net interest margins come down, it will not get fully offset by loan growth. So I think there will be some deceleration for the banks. The only bank that we like at this stage is DBS, because we think that their balance sheet is strong enough to withstand some of these NIM pressures. So there you have it. This is fresh sort of ideas as interest rates get cut. You can see some of those picks on the screen right now in front of you. Now, let's go a little bit more wider to the region, and let's bring Anand in at this stage. Anand, welcome to the show.
Hey, Dylan, thanks for having me.
Now, your new ASEAN Plus note is out, and ASEAN Plus is a research piece that looks at the overall views of all our heads of research across ASEAN and how we should be positioned. So do have a read through that in our newsletter today. Now, Anand, before we drill down to the different countries, any quick observations on the impact to ASEAN from lower interest rates?
Yeah, no, I think you've already touched on this, Dylan, in terms of the sectors which are rate sensitive, like property, also those with high gearing or very capital intensive, like utilities or industrials or telcos, would tend to be the sectors you want to revisit as interest rates come off due to falling interest costs and all the other factors you mentioned. I must say that ASEAN central banks have been quite slow to cut rates. I mean, they're still watching. If you look at the interest rate decisions this month by Bank Indonesia, as well as Bank of Thailand, they've decided to stay flat or stand pat. Only the Philippine Central Bank has cut so far by 25 basis points, and this has a very interesting offshoot. Yeah, and it's quite good for ASEAN. ASEAN markets have rebounded with global markets, but at the same time, many ASEAN currencies have held on to their gains against the US dollar since the whole volatility and Fed pivot issue began earlier in August. One classic example, Dylan, is Malaysia, right? The ringgit has been the best performing Asian currency year to date. So if you look at the KLCI, it's up 13% year to date, which is already very impressive. But in US dollar terms now, it is up 18%, which is the best performing Asian major benchmark. So that's really, currency is really starting to become a key attraction for ASEAN investors as well.
Got it. Yeah, so that's exactly where I want to focus now. So let's focus on Malaysia for a minute. Best performing market, as you said, in the region and in Asia, I would think. But can this momentum continue? And if it does, where are some of your top picks?
Yeah, so the signs are good that the momentum will continue. I think if you look at GDP momentum, Malaysia has been posting quite strong GDP numbers. The second quarter was ahead of expectations. We now expect 2024 GDP growth to exceed 5%. So I think ASEAN has been seeing a lot of GDP upgrades, and Malaysia has been at the forefront of that. So that's lifting sentiment. Also, you're seeing a lot of investment, both in terms of foreign direct investment in tech, in RE, in data centers, as well as domestic investment in infrastructure as well. And that's keeping the market quite active and quite robust. Tourism is recovering quite nicely as well. And I think reforms are a major driver as well. Many ASEAN countries struggling a little bit with politics and getting policy on track. Malaysia, fortunately, has been quite stable on the political front, and that's allowed policy to advance. So we've seen diesel subsidies being rationalized. We're seeing a lot of support for industries like the National Semiconductor Blueprint being released. That's also supporting market sentiment. And next up is the big one. Johor Singapore Special Economic Zone. We expect that to be confirmed by the end of the year, and that's going to be quite catalytic on a very broad level for the market as well.
Right, so a lot to look forward to. Viewers, you can actually see some of our ASEAN topics on the screen right now. Now, Anand, turning to Indonesia, how should we kind of look at the recent political uncertainty? Does this take away in any form the very ambitious 5.2% GDP target and the 2.5% fiscal deficit target that the government has set? And what are some of your top picks there?
Yeah, it's certainly a distraction. I think if you look at the budget by itself, it is quite a credible one. And I think it stays on Indonesia's long-term sort of fiscal consolidation trajectory. And that will make investors in Indonesian or rupiah assets quite comfortable. Now, the political unrest due to attempted changes to the election laws, that's something I think that's not new to Indonesia or the broader ASEAN space. Politics has always been something investors in this region have to watch out for. And as it stands right now, we don't expect that unrest to become uncontrolled and affect the investment picture for Indonesia. So we remain quite constructive on Indonesia in the wake of the recent budget. I think if you're looking at picks, three sectors do stand out for us. One is the interest rate sensitive sectors, property. So we like stocks like Ciputra, Sumarikon on our buy list. We do expect rates to start coming down in the fourth quarter by about 50 basis points. So it's going to be very stimulative for that sector. Also banks. In Indonesia, banks actually do see margin expansion as rates come off. So quite contrary to many other banks in the region. So if you want to play that margin expansion story, banks like BCA, Bank Rakyat are top picks. And the third sector is really a value play, and that's the commodity space. Commodity stocks have not done very well. Many commodities have corrected in terms of pricing. So we think this is a good time to bottom fish. So things like Vale, Aneka Tambang, and United Tractors would be on our buy list there.
Got it. Thanks, Anand. Now, let's turn to Thailand. Thailand has a new prime minister. So what's next for this market? This has been one of the worst performing markets in the region so far. Is this the point it turns around?
Yeah, Thailand, full of political surprises. It's been a bit of a roller coaster last couple of months. Things do seem to be settling down now with the appointment of the new prime minister. I think, we do expect the cabinet to be firmed up over the next couple of weeks as well. So our head of research doesn't think there's going to be any major changes in terms of the coalition lineup or even the cabinet. So I think the key here is, whatever's happening at a political level in terms of personalities, the policies themselves that the government is pursuing may not change dramatically, especially fiscal disbursements, which have been holding back GDP growth in the past. Those apparently continue to be expedited or accelerated. And we don't see that changing. So that's going to be quite good for growth into the end of the year and into 2025. So I think with Thailand, we remain quite selective. Clearly, being the laggard market in ASEAN, it does show a lot of value, but we are also cognizant of the risks in terms of GDP underperformance, as well as continued political noise. So three areas stand out for us. One is the sort of budget or policy plays. This is where accelerating budget disbursements will lift specific stocks. And this space, we like stocks like Siam City Cement, as well as Tesco as well, and CK. Yeah, those are all very infrastructure-oriented stocks, which should benefit from budget spending accelerating. The second area is tourism. So tourism is recovering very nicely in Thailand, helped by things like visa waivers. So things like AOT is on our buy list there. Also, Bumrungrad, medical tourism is rebounding quite quickly as well. And the third area and final one is margin expansion. So we do see a scope for synergies in the telco space. So something like Advance is starting to sort of report merger synergies emerging and lifting profits. So we like that stock. Also global power as well in the utility space.
Got it. Thanks, Anand. That's all the time we have. So thank you so much for joining us. And that was Anand, our regional head of research, joining us. Now, let's move on to technicals. Our chart guy has two stocks today, a trading buy and a trading sell. So on the trading buy side, he's highlighting Centurion. Some of you viewers would recall we've had them on a few times for various roadshows and so on. He thinks that this is still, there's still a lot more upside for this stock. On the other side of the trade, Samudera shipping is on a trading sell at this stage. So I think something to watch out for. And there's a lot more information in the newsletter today. Let's quickly turn to some of the key dates that are coming up in terms of announcements. We've got Singapore's industrial production numbers coming out on today. We also have results coming from ASL Marine and Micromechanics on the 29th. We've got bank loan numbers. That's quite important to see whether we're starting to see a thaw there coming out on the 30th of August. So quite a few econ and results to watch out for. In terms of events that are coming out, on the 3rd of September, we have a corporate access event to Bangkok Dusit Medical Services. And we also have a Malaysian corporate access event to Burma's Auto Berhad. Some of these are invitation-only events, but do speak to your salesperson to see whether you can get an invite. With that, we've run out of time. Thank you so much, as always, for joining us. And thank you so much for all your support for Monday Market Picks. Have a profitable trading week, and we'll see you next week.